At Azim Premji University, I teach two courses. One is on financial inclusion. The other one is on understanding livelihoods. My focus was largely initially from a microfinance institution or an organization's perspective. Since I also did my PhD from IIM Bangalore, the focus was on how do organizations deliver financial services efficiently, right, and being profitable and so on. That was the focus. But once I started trying to understand how do households actually manage their finances. So till then the focus was on how do organizations manage, but there is also the most important part, which is the client of the microfinance institutions who are from low income households, right, largely. Then how do they manage their finances? Where do actually the financial services actually plug in into their needs? Do they plug in very well? So these were some of the questions that I was questioning as I started looking at individual households in greater detail. And then I realized that while a lot has been done in our country on the supply side of financial inclusion, I began to realize that probably we have not done enough on the demand side, in understanding the demand side. So my focus today will be, see, I can give you a lot of data on SHGs or cooperatives or bank loans and so many other things, but that is all out there. So what I want to focus in today's interaction is understanding the demand side, right, and understanding the objectives with which the financial inclusion efforts in the country have come up. What is the objective behind that? What were they actually trying to address? How were they trying to do it? So I'm not going to focus on a particular kind of institution. I'll give a very broad landscape and then look at some of these, what we call as design principles or motivation, or what is it that is not being addressed, and probably I'll leave you with more questions than what we are starting off now, right? Yeah. Okay. Oh. Okay. So two broad items for discussion today: the demand side, why do people need access to financial services, and the supply side, who are the providers, right, and how are they providing the services. That's the focus of the so I'll show you 2-3 graphs. Okay, please pay attention to the numbers on the graph and how the graphs look. For example, this is probably around 50,000. That's the, so this is the income or the inflows, and this is the expenditure. Okay, this is around 50,000, and if you this is one. So who do you think will have this kind of cash inflows? Absolutely. So you have a very regular steady cash inflow, and it is a salaried person. Yeah. And this amount is around 7.5 to 10,000. That is the variation. And probably, I mean, this could be anybody. You can see that the income is not stable, it is varying, right? And probably there are certain periods where the income is quite low, right? It could be true of many self-employed people, or yes, in this case it is a daily wage laborer. Absolutely, yes. So because twice, 2 or 3 times in a year is when they get lump sum into their hand. And yes, this is something from a study that we are doing, and this is the average income of a street food vendor over certain months, right? So what can you understand from these 4 graphs? There are certain times when there is a spike in income, or the entire income comes to the household as a lump sum. Yes. I think all the points I have listed probably you all have come up with. Yes? So first is that, when we talk about $1 a day or $1.25 or whatever it is a day, we don't actually get that dollar a day every day into our hands, right? This is just an average estimate, right? So there may be periods where you don't get anything at all. I mean, where the low income households don't get anything at all. So there is uncertainty and variability of income in addition to low levels of income, right? But the needs are many. So if you observed the cash outflows, right? So one is we have the basic needs, right? Roti kapda makan, and one of my students actually, when I asked him what are the basic needs, he also said internet. Roti kapda makan and internet, but I'm not counting that here anyway. So yeah, so we have the regular living expenses. Then we saw certain spikes. It could be illness, or it could be some kind of an emergency. It could be a marriage or birth of a child or anything else, spikes that are there, or including finding a new opportunity for production which requires certain investment and so on. And yes, like unforeseen and unplanned expenditure, right? So like you all said, income spikes and the expenditure spikes don't match. There is almost always a time lag, right? In such a case, how do we understand financial lives of the poor? So how do low income households, in the face of this variability, uncertainty and low levels of income, how do they meet their basic needs? How do they plan and budget? How do they meet expenses on big ticket items? It can be repair of a roof, it can be buying cattle, right? Or life cycle events and so on. The question that we need to ask is, how do households manage money when there is so little of it? There have been in multiple countries these studies undertaken to understand the financial lives of the poor, to see how they manage money, how do they save, and where do they borrow from, and so on. So in different countries at multiple points, different studies have been undertaken, and the studies find that the poor people, the poor households, manage their financial lives very, very well. They have very active financial lives, right? We only think that somebody having access to bank or somebody connected to the stock market and so on probably is very active, but the poor people, the number of instruments they use for borrowing and saving, the number of sources for borrowing and saving, and not just borrowing and saving in cash or money or financial equivalents of financial assets, but also in kind, which is intermediation of goods and services and labor, right? And yeah, so there are very active, the low income households lead very, very active financial lives, and their awareness levels within that, whatever they are managing, is also quite high, right? So money management is a very well understood part of their day-to-day life. So when in these financial diaries, when they were asked about what are their needs that they would prioritize, health came first, followed by education, and then money. But however, like we know, without money it is also difficult to get health as well as education, right? So going back to money management and understanding money management, many years back, so I was talking to chicken curry, Lucknow chicken, the artisan from who was working with Seva in Lucknow. So she was so good with numbers that we were trying to understand, how much she gets paid, what happens if the cost of material goes up, then how does her earnings change. So before I could calculate, she was there, within a couple of minutes she did a lot of percentages and calculations. She was faster than me. And then in the course of the conversation, I asked her, I said, which class have you studied till, or whatever, what's your education background? She said this, Anguta chap, right? She said, yeah, I haven't, I'm not educated, I can't read and write. But her ability to calculate, right, was very, very good. Yeah. Anyway, I'll come back to this point a little later when we talk about financial literacy. So in a study, in a survey carried out of households, this was done in 2015, right? I think around, I don't remember how many households were there in the study, but anyway. So the idea was to see that how many households have actually witnessed events with a major impact on their household finances. So many of them, almost 30%, close to 30% of the households said that one of the things that would put a dent in their finances is either bad weather, drought or floods or pest attack and anything that impacts their livestock. The other one is a major medical emergency and or job loss and so on. I mean in the decreased order of importance. So any of these events occurring could completely derail the household finances. And you all must have heard about Aniruddha Krishna's book on One Illness Away, where he says that one illness is all that is enough to plunge households into poverty. Coping strategies. So the first, if you see, the first source of help that they turn to is help from friends and family, then goes to household, dipping into their household savings. Then dipping into the household savings could also be not just cash savings, but it could also include sometimes sale of cattle or any other assets that they can afford to. Then loan from a money lender. So if you look at it, almost most of the situations, either all crisis situations or medical or damage to property, loss of crop, everything, they all turn to informal sources of finance, right? And the bank, loan from a bank is hardly there, that's the green band. And even aid from NGOs is hardly there, right? So if you look at it, more than probably 60-70% of their emergency needs are met by informal sources. And there are usually households, the coping strategies, there are three ways that they try to manage. The first thing is, if the need is not so important, then they go without that. The second one is to sell their assets, and the third one is use past or future income to meet today's expenses. When I say past income, I am talking about savings. When I say future income, I am talking about borrowing, right? These are just, so when I save money and I dip into it, I am using my past income. When I am borrowing and repaying it into the foreseeable future, I am dipping into my future income, right? So that is what they do. And like we saw in the previous graph, the formal sources form a very small portion of the emergency sources of funds of households, and typically they turn to suboptimal solutions. So what happens when people borrow at a very short notice from, say, money lenders, loan sharks or anyone else? Typically they are either exploited, or when they try to sell their assets, they don't get the optimum price for that whatever asset they are selling. So there is a suboptimal solution. So it's a double whammy in that sense. So who do you think are, so one is, so far we said that yes, there is definitely a need for formal financial services, but we know, I mean we are here today because we know that there are so many people who are excluded from these financial services. So who are the excluded? Yeah? Okay, urban poor. Yes? Tribals, absolutely. Marginalized. Marginalized? Yeah. Farmers, yes. 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 Right? I mean, there is many more. I just put a few, whatever you said here. So there are certain groups of people who are excluded from financial services. Why are they excluded? Okay, one is you're saying that the people themselves are not aware. Okay. Lack of security, okay. They don't have assets to provide a collateral or security, yes. Lack of equity, their own investment, yes. Or ability to invest, yes. Lack of social capital. How do you think that impacts why they are excluded? Don't you think farmers have social capital, probably than say, than urban class or so on? Okay, we'll come to that. Yes, you had a point. Yes, absolutely. So, if we look at it, so one is from the client side or the demand side, there is distrust of banking systems, there is low levels of financial literacy, lack of awareness of the kind of products, there is lack of appropriate products. So, somebody wants, a poor household may want a proper safe savings product, but there are not enough savings products out there, or there is high level of transaction costs, right? You know, in terms not just costs in terms of traveling, but also loss of days work, right? And filling in forms that they don't understand, hostile bank staff, right? Usually, you know, people probably are dismissive if somebody goes there for a 5,000 rupee loan. Bank staff also have their targets, so they would rather entertain somebody with a 10 lakh or more, whatever it is. Yeah. And then if we look at from the supply side, one is that there is information asymmetry, there is no credit history at all, therefore we don't know what these people are doing. And also if you go back to the slides with the graphs where we said income variability, uncertainty, so that is also not there. And then lack of assets, definitely yes. All these actually make these potential clients from low income households a high risk profile clients, and therefore they are not considered profitable, right? Yeah. And then the cost of providing last mile access is, you know, remote areas or areas with sparse population, and providing or opening a branch there, or even in, maybe installing an ATM with low population density, right? It's a costly affair. And then also the very low volume of transactions that comes from these areas. So this usually deter financial service providers or the supply side to move towards, you know, providing access to financial services to those who are in need of it. Yeah. So what do actually the poor households need, right? They need to save money, they need credit or loans for their business activity if they want to build a house, or if they want for, you know, if there are any emergencies, or for education of their children and so on, right? And they should be able to send money to families who are living in any other place. and insurance, and then pension for old age, right? These are the broad 5 needs that not just low income households, any of us would need, right? How many of you don't have a bank account here? Yeah? You don't have a bank account? You don't? You have? No, I want to know who doesn't have a bank account. Who has not used a credit card ever? Not used a credit card ever, but do you use Google Pay, Paytm and so on? Okay, then you don't qualify, you are not excluded. Yeah, so yeah, so see, the point is, can we imagine not having a bank account, not having a means to get money? I mean, some of you who may not be using credit card, maybe you have your access to parents card, or you have alternate means of, you know, transferring money and so on, right? Huh? Yeah, debit card. Yeah, absolutely. Nowadays, yes, debit card is there, right? Yeah. Or can we imagine going for a week without using any of these? No credit card, no debit card, no. Just try if you could, but I'm not so sure, right? Yeah. So that is what we are talking about. Sorry, what did you say? Survived. Yeah. For how long? Was this during demonetization? Recently. Okay. How did you spend?
If I don't have money, I don't need to spend. I don't buy anything.
Yeah, but how are your needs met? You already, if you are living in a hostel and you already paid fees for the hostel, even if you don't have money in your pocket, then your needs are met, right? But if you are not living in a hostel, then would you be able to survive? Yeah, right? So we can manage because we have some other ways of actually meeting our needs, right? Cash surplus, absolutely. We may have cash surplus, or we have something like, for example, I mean, if my daughter is in a hostel, I would have paid the semester fees for her, including the hostel fees, so that even if she doesn't have money, she'll get food to eat and a place to stay. That is taken care of, right? Yeah. Okay. So these are the 5 needs that any one of us will have, and we all have access to formal financial services, and in the absence of, if there is cash surplus, we can probably still manage without the formal, some of the formal financial services, but we saw from the first 2 graphs again that we don't have cash surplus, and the inflows and outflows are not matching, right? So we come back, therefore, yes, there is a need for people to have access to financial services. So let's look very quickly at the definition of financial inclusion. But I mean, since this is a very well informed group, I'm sure you already would have been familiar with what this is. Essentially is about, financial inclusion is about broadening financial services to those who do not have access, and deepening financial services for those who have minimal access or minimal access to only a small range of financial services, and then also about financial literacy and consumer protection. So similarly, Rangarajan committee report also says something on similar lines of providing appropriate financial services are made available to those who need them, and enabling them to understand what these services are and how do they manage, and ensuring that they can access those services. Okay. So 3 things. So as we go along, we will look very quickly at 1 or 2 of these. Definitely access to financial services and products, all those 5 needs that I said, savings, credit, insurance, pension, right? and so on, and emergency needs. All those 5 needs definitely have to be there. We need access to different kinds of products to meet that. In addition, we should know what product to use when. What is the product that meets our requirement very well, and then also our ability, the household's ability to manage money. So that is what we are calling as financial capability, right? So financial literacy is just about knowing or understanding, what is a simple interest, compound interest, how do we pay, and so on. We are understanding all that, what kinds of products are there. But capability is one step ahead, which is also, thinking about planning, selecting appropriate products, also being able to manage money through various instruments and sources and so on. So, having laid this this picture of low income households who need access to different kinds of services to meet the various life cycle needs, emergency needs, investment needs, production needs, consumption needs, and so on and so forth. Let's look at what is this scenario like in the country. Who are these service providers? But before we go to that, how many of you have done a course in microfinance? Okay, so was it just about microfinance institutions? Did you go, right? Community based. Okay, right. So probably some of this is a little bit of a repetition for you all, but yeah. Right? So if we just want to look at the, how can we map financial service providers in the country today? We have, on one hand, we have informal sources of financial services and going along to formal sources, and then from individual to member based kind of financial services. So informal to formal, I'm sure you all understand. Informal is just, there is no formal contract or regulation of the entity. It is just, it could be an arrangement between 2 individuals or a group of individuals, right? So we have something like friends, when I borrow from a friend or a relative, it is largely between that lender and the borrower, or a money lender or a trader or even an employer many times. These are all very informal arrangements between individuals. On the other hand, member based informal, we have chit funds, right? You're all aware how chit funds work, but we also have formal chit funds, but I haven't put it here, right, which are almost like individual, formal and individual, that is where they would come under. And we have self-help groups, right? And then we have, formal and member based, we have the entire cooperative banking system, the microfinance institutions, which are, which lend to self-help groups, right? Largely group based lending, that is what they follow. Yeah. I mean, there could be, probably cooperatives, it's a little bit, it is, if you're talking about the primary agriculture cooperative societies, then they would probably fall more towards the informal, and sometimes, and cooperative banks would be more towards formal banking and so on, but you get the idea. So a quick look at, when did SHG start in the country? Yeah? Yeah, it's actually mid 80s probably, with Seva, Mairada and Pradhan and all these organizations, somewhere close enough. And 1992 is where the SHG Bank Linkage Program, SBLP, that was started. So, see, the SHGs in India and linking them to banks can actually be considered as a paradigm shift, in the sense that till then, you know, banks were either lending to individuals or they were lending to registered entities. But lending to SHGs, which are an informal group of people, that was one. Accepting informal groups as clients. The second one, for both for deposit as well as credit linkage. The second one is introducing collateral free lending, right? And the third one is to lend to groups. Typically when you lend to, when banks lend to individuals or corporates, the purpose for which the loan is going to be used is very clearly defined, right? And that is also assessed whether that idea is viable or not, whether the bank is in a, you know, you will be able to repay the money to the bank or not. But you know, with SHG bank linkage, the idea that you can lend to groups without specifying the purpose, which means the group actually decides how they are going to utilize the money. Bank has no control over it. So this is one of the changes in the way banking activities were being provided. So 3 points. And in 1992, if you see, SHGs, be it NABARD or the NGOs and SEWA and others who have come up with this idea, and even RBI, they looked at SHGs as a model or a tool for extending banking services. So pushing the boundaries of financial inclusion. But if you look at what, I mean 27 years after the SHG bank linkage program, if you look at where do SHGs or what are SHGs today, they are no longer, you know, they are like actually mini banks or mini cooperatives, right? People coming together, pooling money and using that saving to get linked to bank for loans. But they are no longer, the purpose is no longer financial services or banking alone. They have become an instrument of the government to deliver multiple other services in terms of healthcare, in terms of so many other, you know, whatever government benefits. I mean, SHGs are one of the vehicles through which these are all delivered. Now, in doing so, has it compromised the banking aspect or the purpose with which SHGs were originally formed? So we do know that there are many SHGs which are probably not doing well. There are SHGs who may have defaulted. The loans to SHGs are highly subsidized under various programs, be it the IRDP, SGSY and the NRLM, right, in that order, right. They have all looked at SHGs as vehicles, but then at one level the focus was more on extending subsidized loans to these groups rather than on building their capability to use the money that they get and invest it in some kind of a productive activity. So in some fashion, as the numbers increased and as we saw them as vehicles for something more than financial inclusion, then also I think probably there was some kind of a dilution of purpose when promoting the SHGs. Now we will just take a quick look at the banking structure in India. We have something close to 1.3 lakh bank branches. If you also add the number of the post office outlets, that is another 1.5 lakhs or so. The number of post office outlets which provide saving services, and now with the transformation to a postal bank, payments bank, right, 1.5 lakh services of that. I am not adding the number of ATMs here. I am also not adding the number of business correspondents, right. So if you actually look at it, the architecture, this could be somewhat this will change because of all the bank consolidation, right? Recent announcements. Yeah, this is last year's numbers. So, as far as the banking architecture and the number of institutions are concerned, seems to be quite good. And if we take a closer look at the cooperative banking structure, if we look at the cooperatives, we have another 1 lakh primary cooperatives out there, more than 1 lakh. So, look at the number of entities in terms of branches and so on that are providing financial services. We do seem to have a good number, but what is the story of some of the performance of some of these? So, cooperative structure, I am not getting into the history of the cooperatives because that is probably a half a day session and so on, and how cooperatives. I just have 1 or 2 slides on cooperatives, which is saying very, very little, but yeah. So, cooperatives have a membership of more than 120 million, and they are one of the biggest rural financial systems, and also SHGs are actually one of the largest women owned entities in financial services in the world. Our SHG system is one of the largest that way. And SHGs, yeah, there was something that I forgot to mention, was that we have close to 1 lakh SHGs covering, I think, 12 crore households and some 87,000 crore loans outstanding, right? It's a massive spread in, say, 25 years of SHG bank linkage program. Yeah. So, yeah, in coming to cooperatives, we have around 120 million members, and unfortunately, if you look at the performance, they have more than 30% arrears or defaults. In 1980s, the cooperative banking system accounted for 50% of agriculture credit. Sadly, it now accounts for probably only around partly. See, one is that cooperation is a state subject. So, the registrar of cooperatives in the state, they have a control over management issues, who is to be the chairman, when are the elections to be conducted, when is the AGM to be conducted. So, these kind of issues, it is all the registrar of cooperatives. When it comes to the banking functions, they are covered by, they come under RBI, under the Banking Regulation Act 1959. So, it is a dual control. So, banking functions is RBI and the other functions is the registrar of cooperatives, which actually kind of leads to challenges in the way cooperatives function. The other one is that of a borrower driven structure of cooperatives. Let us take the case of a cooperative bank. There are depositors, there are borrowers who are the decision making members in that cooperative. Is it the depositor? It's there here. It's the depositors who decide. The borrowers are the decision makers, and depositors are only nominee members or non-members. So, what is happening is that I am borrowing from the cooperative bank and I make decisions, and I make decisions about controlling depositors' money who don't have a say in the decision making, right? That actually, I mean, if you look at so many cooperative banks and scams in the last so many years, you would, this seems to be one significant problem, because see, I am only borrowing money, I am not losing anything. If at all, if something happens, then I am actually gaining. Whereas as a depositor, I don't have a say, right? And something goes wrong, my money goes. So, if a borrower is making, taking decisions, that introduces some kind of a moral hazard there, right? Yeah. And the other one, I mean, there are issues of management and HR, like I said, the political hijacking of the cooperatives, the election process, all this we are not, yeah. And managing finances as well. Yeah. So that is one. So we have talked about SHGs. We have looked at very briefly at the cooperatives and some challenges. Now we look at a third kind of entity, which is the regional rural banks. So the point is that in India we've had many innovations and experimentation with the models for delivery of financial services, with the kind of institutions. So RRB SHG is somewhat based on the cooperative principles. Then we also have something called the small finance bank. So there is a lot of innovation and experimentation with the delivery models, financial products, and the institutions themselves. So we're just trying to understand how these changes have happened, right? So now the regional rural banks, on one hand, before the RRBs came into existence in the 1970s, on one hand we have the cooperatives, which are very local. They know the local needs and problems and so on. And on the other hand, we have the commercial banks, scheduled commercial banks, which are somewhat distant entities, not really happy to get into rural areas and lending to the marginalized and so on, providing services to the marginalized. Right. So the idea of this RRBs came about saying that we will have the professionalism and resource base of commercial banks combined with the local feel and familiarity of rural problems that cooperatives have, and then come up with this entity called regional rural banks. So the purpose with which they were set up is for development of agriculture, trade, commerce and so on in rural areas, and providing banking facilities to small and marginal farmers, agricultural laborers, artisans and small entrepreneurs in rural areas, and then also ensuring that we mobilize deposits from rural households, right. So this is the objective. So it was, I mean, for a certain period a very interesting story that they grew from 6 RRBs in 1975 to 196 RRBs in 1991, and with the presence of in multiple states. But if we look at this is 2015 data, but now it is even fewer than 56 banks, right. There have been large scale consolidation mergers of regional rural banks. We will come to the reasons in a while. So if we look at the regional RRB branches, 75% of the branches are in rural and semi-urban areas. Till 2004 it was almost 97%. And then 62% of the borrowers are small and marginal farmers. So they are actually meeting the purpose with which they were set up. However, and they also account for 82% of loans from priority sector. However, since the RRBs are focused in specific geographic areas, they were not very well diversified in terms of the kind of activities that they were lending to. So what happens is, you let us say RRBs are lending to a group of small and marginal farmers. If there is a natural disaster or if there is a crop failure, they are unable to pay back the loans. And because the RRBs are not well diversified in terms of the activities that they lend to, they are obviously very poorly hit. That is one of the reasons. So because of this, many RRBs were found to have severe eroded their net worth, and therefore multiple RRBs have been consolidated, merged, and therefore we came from 196 to probably around 50 or so in the current day. Yeah. All these, in terms of say RRBs, or in terms of say commercial banks also lending to the marginalized, or commercial banks lending for agriculture, all these was made possible because of priority sector lending, which I think in the 1972 or so was when the first set of guidelines for priority sector lending were framed. Priority sector lending is all about directed credit to those groups who were excluded from that. So we have around 40% of adjusted net bank credit is supposed to be for priority sectors, which are agriculture, exports, education, housing and so on, micro enterprises and so on. I am just listing those that are important for financial inclusion. So agriculture loans 18%, of which 88% is for small and marginal farmers. We have 7.5% of the adjusted net bank credit allocated for micro enterprises, and loans to banks and SHGs is also covered. Loans to weaker sections, so loans to women, loans to the disabled and so on, all are all covered under the priority sector lending targets. So, I mean, just to look at what has been happening over the last few years. So, one is we have the universal banking. When I say universal banking, I am talking about banks that provide a range of services, the entire gamut of financial services to individuals, corporates and other entities. But as we, while the priority sector lending was there, targets were there, we had cooperative banking system, we also had regional rural banks and so on, focusing on the rural areas and the marginalized. That was not adequate. Say for example, what happens to the marginalized in the urban areas, right? So there were some challenges, and therefore the thought of having this kind of differentiated banks, which is in terms of, you must have heard that there is something called a local area bank, which are set up in 2-3 contiguous districts together, not more than that. We have 3 or 4 local area banks, not many. We also have, RBI gave licenses in 2015 to small finance banks as well as what is called as payments bank. So what is happening is that small finance bank, they provide a range of banking services, but there is a cap. They probably cannot lend to a few hundred crores to a corporate entity. There is a cap in terms of the loan sizes that they can give out and who they can give it out to. In terms of payments bank, there is a restriction on the kind of services. So payment banks, for example, cannot provide deposit services beyond 1 lakh rupees. Yes. And then we also have, right, we are trying to push the boundaries further. We also have the business correspondents. These are agents who work with banks to provide simple banking services to the excluded population. One is within bank business correspondent or banking correspondents. Again, we have different kinds of models. One is the microfinance institutions which are already there, they work as agents. The other is that, the local kirana stores or individuals, they work as the agents. The advantages are that bank doesn't have to open or spend on physical infrastructure. So there is already somebody who knows, who belongs to that area. So he helps them provide financial services, not just credit but other services as well, and therefore it is much more economical to the bank in that sense. And for the customer, since the person is there in their village, so their transaction costs also come down. They don't have to travel, there is easier physical access, and the business correspondent are not seen as somebody who's, not as intimidating as say bank staff. Right. So all this has been happening, right? Different kinds of institutions, different kind of models and so on. But there is, all this actually has to be regulated. It's not that anyone can just start any kind of financial service. So here we are talking about the marginalized, so if something goes wrong, then we are putting their hard-earned money at risk. So yeah, there have been regulatory interventions. The first one is to say allowing banks to open SHG accounts, then mandated priority lending, and till recently, if somebody had to open bank branches in very lucrative urban centers and metro centers, there was a requirement that they open a certain number of branches in underbanked areas, right? Branch licensing policy. So that was one with which RBI ensured that banks could open branches in rural areas. And the third one is to say that banks can open no frills accounts where the KYC norms are also relaxed. So for example, I mean we have Aadhaar now, but if somebody doesn't have an Aadhaar, they can produce a letter from their the chairman of the panchayat, say, you know, and that will be valid till they apply and get an Aadhaar card, right? So relaxing the KYC regulations for small value clients and transactions, allowing branchless banking in terms of the business correspondence, and more importantly, why microfinance picked up in the country is also deregulation of interest rates for small loans. So this is one very important regulatory effort. So for example, like we said that, you know, for financial service providers, it becomes very costly to provide small loans in difficult to reach areas, right? So on top of that, if the interest rates are controlled, the whole, you know, this providing financial services to such population is not very viable. So deregulation actually helps push the financial inclusion boundaries. Now, we have looked at, you know, from the banking side what has happened largely, and to some extent SHGs and the informal. But there is this whole range of entities called microfinance institutions, right? So how did microfinance start and how did it proceed? So I'll probably try to conclude in the next 10 minutes, so we'll have some time for questions, right? So when microcredit, as it was originally called, when it started in Bangladesh, the idea was that the low income households, why it started or why Professor Muhammad Yunus started microcredit was that the low income households are typically caught in a trap, in a vicious cycle, which is of low income, therefore low savings, therefore low investment and low production, and the cycle goes on. So the idea was that if we break this, I mean this also obviously leads to low consumption, but however, if we break the circle here in terms of ensuring that their investment goes up, hopefully better investment leads to better production and income and savings, and then the cycle goes. That was the idea with which microfinance, microcredit, why was this focus on microcredit was precisely for this reason. Okay. So in India, we had different kinds of SHG models. I'm not talking about now, but I'm talking about from you know, whenever microfinance institutions started. So there were differences in their mission, in the target clients, in the area of operations, right? That was the period when 2005 was the International Year of Microcredit, right? From then on, actually it had taken off. Yes? Yes, 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 yes. So this is the story till 2010. Unfortunately for India, 2010 became the year of microfinance meltdown. Yeah. So what happened, we'll just see. But what happened in the period in the late 1980s and early 90s when microfinance started as a social purpose, microfinance institutions started as social purpose entities. Their objective was not to just give loans, recover money and make money, but they were giving loans with the objective of alleviating poverty through funding or financing income generating activities for low income households. That was the purpose. But slowly, as you know, people realized that microfinance can be a very successful model. Poor people borrow and they repay money with interest, with high rates of interest, right? It's a very profitable segment to be in, right? The recovery rates in microfinance are much more than general banking. The default rates are very low. So therefore, as the number of microfinance institutions started expanding, so initially the microfinance institutions which set up as not-for-profit, they were funded by subsidized loans, grants and so on. But as the number of institutions increased, the amount that is available as donation or grant and so on, that came down. So they started accessing commercial sources of funds, and that is what we are talking about, commercialization of microfinance in India or even worldwide. So what happens the moment you start accessing commercial sources of funds, right? It can be in terms of loans that you are getting at market rates. It can also be in terms of equity, which means the investors want return, substantial return. So there is a pressure to look at numbers and growth. And once that happens, your understanding of client needs or the effort the institutions, microfinance institutions put into understanding client needs, that came down. And so we have this impatient investors looking for high returns, exit, IPO, and then we get multiple times whatever we have invested and get out, right? And what happens, and we also have multiple MFIs all looking at the same set of clients. So multiple lending, as in many MFIs lending to the same set of clients, right? And there are high rates of interest. I'll come back to why that is. And we also want efficiency. We want to bring down our costs. Efficient operations because we show better returns. So standardized products, we no longer care about what the local needs are. Local culture and economy we don't try to understand. We are not responsive to what is happening locally and so on. So what happens is that the market, once the commercialization happened, the market forces actually, well, I can't say market forces forced MFIs, but in general it so happened that MFI started looking at poor as a market and credit as something like an FMCG. So you all know about what happened in 2010 in Andhra Pradesh, right? Yeah, many of you are familiar, so we will not go over the history, but we will look at why this happened. So this is typical of so many bubbles that usually we keep hearing about, right? So there's a heady success, tremendous periods of growth, periods of tremendous growth followed by a crash. And so one of the reasons, growth at a unnatural pace of MFIs as well as of the number of clients, and then looking at clients as data points and not actually investing time in building their capacity, zero tolerance towards default, right? Taking drastic actions, loan recovery agents to recover loans from these households who are already overburdened, essentially competition leading to over indebtedness of clients and their inability to repay, and therefore finally collapse. So it's the same story not just in India but elsewhere as well. Moreover, in Andhra Pradesh there was a competition between the government program which was forming SHGs, and we have the MFIs which are forming these joint liability groups. So MFIs, in their rush to grow, were trying to poach SHG members, right? So there are multiple things that happened. Obviously didn't go well with the Andhra Pradesh government at that point. So there are political reasons as well. So I just want you to focus on two numbers here. We know that what is the average number of members per family in India? 5 or 6 or 4 to 6. Actually, if you look at the statistics in Andhra Pradesh, the number of microfinance clients to the number of poor households is 10. So which means even if I am giving loan to each and every member of the household, including the children and this, even then it is more, right? And the average loan per poor household that was given was around 67,000. What is the average income of a BPL household? Or let's take the average income of a farmer's household, probably 6,000, 7,000 rupees, right? But then here the loans are 67,000 rupees, and all this at 28-30% rates of interest. So even if we take simple interest over a year, here it was actually fixed rate of interest, right? Yeah, and the interest was not calculated on declining balance, that is what I meant. Yeah, so on 70,000 rupees, if I were to do even a 20% rate of interest, look at the amount that the household has to pay. There is no way that they could have repaid. And in the absence of investment opportunities, all these loans went towards consumption. TV खरीद लिया या कुछ और खरीद लिया, right? I mean, poor households have aspirations. Every one of us has aspirations. We would like to have a new phone, right? Whatever it is. So most of the money went towards consumption, and this is money borrowed at high rates of interest, which is not generating any additional income for them, but which has to be repaid periodically. Yeah, so that there is the recipe for disaster. So obviously at one point one household was borrowing from 6 to 7 sources. That is how that 70,000 is coming about, right? Yeah. So quest for faster growth and the focus on gains for investors rather than focus on what is happening to the clients, on gains for them. Therefore, no checks at all on multiple borrowing. We all were fantastic. The MFIs are growing so well. They are able to access commercial sources of funds. The number of clients has increased. Number of loans given has increased. That was a very rosy picture that was painted. And yes, problem of regulation, poor governance, politics, you name it, you would find it in this story. Yeah. Right. So the point is, while the credit-based poverty alleviation approach was very good, we are giving loans, there should be more structural and institutional solutions. And if you see the rural distress, I mean, we don't pay much attention to what is happening, rural distress, why people are migrating. When there is no opportunity to invest, when agriculture doesn't give enough returns and people are migrating. So one is definitely rural distress, or even in terms of microfinance, it is not about excluding people, but forcing them into market relations that they are not ready for, without adequate social safety nets. So like I said, many women first buy a TV with the loans that they take, right? So what has happened is that credit in the initial days of microfinance, it was seen as more about poverty alleviation, but as we went along, it became something like unrestrained consumer lending, consumer loans. That is what microfinance had become. So yes, and there are multiple events. So for example, you're all from Bihar, there is this case of ghost loanies, which is influential women get a group of marginalized women to take loans from a microfinance institution, and that amount is given to this lady. So she would do that from 4 or 5 members and then abscond with the money. So her name is nowhere on the books of the microfinance institution, but the actual borrowers are the ones who suffer. So this has been, some instances have come to light in 2015. The other one is of demonetization, right? Demonetization, when most of the rural and informal sector is cash driven, right? At one shot, you're sucking out the cash and the way that their needs can be met. So that definitely had an adverse impact on the repayment rates of MFIs as well. And we all know the NBFC crisis, ILFS, and banks' reluctance to lend to microfinance institutions, right? Especially the smaller microfinance institutions are facing the crunch, which is a very difficult situation. But any such crisis will probably, it may spell disaster for the, microfinance institutions, but more importantly for the poor households. Yeah. So to just recap, what does a client need? Convenience of access. I don't want to lose my hours, my time traveling to and fro to the point of access. The point of access should not exclude anyone, discriminate against anyone. I need a range of financial services as a client. The organization that I approach must help me build a credit history. And there are multiple models, I said here 2 models, but multiple models for me to kind of choose from. Yeah. And the financial service provider, they need to recover full costs that are incurred in delivering the financial services, because a model that relies on either subsidies or cross subsidization between different products will not be viable in the long term, right? It is viable only as long as that source of subsidy exists, otherwise it becomes very unviable. There should be a potential for hybrid models and partnerships, because one institution may not be able to provide all the 5 needs that we listed: savings, credit, remittance, insurance and pension. So there should be a possibility for hybrid models and partnerships, and yes, risk management in terms of adequate financial capital and so on. For the regulator, the concerns are about, is the access universal or is it exclusionary? Is the quality acceptable? Are the clients adequately protected? Are deposit taking entities adequately diversified and capitalized? And the consumer protection principles, obviously. Role of the government, should they focus on populist measures of providing subsidized financial services, or focus on creating infrastructure for provision of this financial services? So there is always a kind of a trade-off. And to summarize, we have discussed this, that in India financial inclusion has been bank-led. There the focus was on developing local institutions and access to credit in one phase, which is the SHGs and cooperatives. Then we also have focus on direct credit, which is the priority sector lending, and rural branches of banks, improving their outreach. And then looking at institutions focused on underserved areas like the regional rural banks, local area banks, differentiated banking and so on. However, I will leave with some of these questions. So is there a trade-off between financial inclusion and regulation? The more we want to include, the more it may become difficult to regulate. So is there adequate focus on building the financial capability and financial literacy of the marginalized groups? Does a mere opening of bank account translate into access? And more importantly, what about creation of jobs, employment opportunities? If you don't have money, what, right? If you don't have money, where are you going to save from, or what are you going to remit, and so on? So do we have this kind of basic, do we have answers to these basic questions? So financial inclusion is definitely very important, very, very important for low income households, but that is not the only solution. That's not the panacea for all ills as it is seen to be. The moment we talk about PMJDY, we talk about Suraksha Bima Yojana, there are so many schemes that we talk about, no doubt important, but largely peripheral as far as the low income households are concerned. They also need strengthening of many more of the fundamental efforts at job creation, employment opportunities, and so on. Thank you.